Hi everyone, I'm a 38-year-old Singaporean 9 to 6 worker living in HDB, simple lifestyle with no car. On this channel, I share my stock portfolio, documenting my journey towards a $4.5 million retirement goal by age 50. I'm 4 years into my 16-year journey so far, with 12 more years to go. In today's episode of The Naked Turtle, I'll share with you some not safe for work unfiltered thoughts about my stock portfolio and the contrarian moves I made in the past 4 volatile years of the markets that netted me $283,000 in gains for 133% returns. What this means is that the portfolio is now starting to reach escape velocity, where the total cash of $277K that I have injected slowly over the last 4 years from my monthly salary is now being exceeded by the gains of the portfolio. Now, this is an important milestone for me because it means that the gains now make up 50.5%, which is more than half of the portfolio or more than what I've put in so far in cash. And that should be the way, because this is the definition of your money working for you. You don't want a case where the size of your portfolio looks damn big from the outside, maybe millions of dollars, but most of it is just cash that you deposited instead of actual performance gains that the portfolio returns passively to you. And I hope this answers a question from a viewer who asked, assuming you hit $4.5 million, how much percent do you think will be your capital and how much will be gains from the market? Using Calculator.net's investment calculator, if we plug in the starting amount today of $560K, which is the size of the portfolio now, and then the amount of time left, which is 12 more years out of my 16-year investing journey, and then the contribution of $60K from my salary I deposit into the portfolio every year, which I intend for it to remain fixed. I then have to adjust the return hurdle, which currently needs to be 14.5%, in order to reach approximately a $4.5 million end goal by 12 years. So to answer this viewer's question, this means that when I reach this goal, a majority of more than 70% approximately should be gains that make up the portfolio. Right now, the gains have reached 50.5% of the portfolio, and so the portfolio is slowly moving in that right direction of gains outpacing deposits. And I know, when I say I need to clear a 14.5% hurdle rate, I can already feel the pitchforks coming out at me. Yes, it is quite an ambitious target as this fund manager has laid out. In fact, previously the hurdle rate was 16%. But of course, as the portfolio trends upwards, this hurdle rate slowly moves downwards accordingly, and it is why it's shifted a bit lower to 14.5% compared to the previous 16%. And I want to warn everyone that what I'm doing is unique only to me. In fact, you should watch this earlier episode where I brutally criticize my own portfolio, so you are aware of the risks with the way I am managing my portfolio, which is not a style that is for everyone. And I promise you that this will be the most transparent portfolio on YouTube, because even when it crashes, like it did 1 to 2 months ago by 20% for about 105,000 Sing dollars during the Trump tariff announcements, I will show you the failures and dips along the way like I did with this earlier episode. On an annual performance basis since I started, the portfolio has done 23.21% per year, clearing the 14.5% hurdle rate I need to reach my 4.5 million target. This beats the S&P 500's performance for the same period of 9.7% per year and the QQQ's at 12.18% per year. Again, I must emphasize, none of this is conclusive because I believe that a 10-year performance review is when we'll know whether it's all luck or if I do have some skill over the market. So please treat everything I say on this channel as entertainment. The portfolio, as you all know, is focused on 5 companies within my circle of competence. And in recent months, I have begun accumulating cash because I cannot find good opportunities at the moment. I do have other companies on my watch list, and I'm waiting patiently for value entries. Some of them I've even been waiting for years. For even more full transparency, these are the 3 brokers I am currently using. From left to right, Tiger Brokers, Mumu, and IBKR. You can ignore those positions with just one share and IBKR stock because they are just free stocks that I was given and I don't count them in my portfolio tracker. So what exactly were the contrarian moves I made that resulted in my outperformance so far? The first is ignoring the temptation to trim your winners. Now, one of the most common mistakes investors make is that they are tempted to trim their winners when the valuation of the stock goes very high. And I understand this emotional temptation because if you don't sell your profits, it almost feels like you are leaving money on the table or that they might suddenly be gone when the valuation compresses. Because these are all unrealized gains, like in the case of my Netflix and Exxon positions that have almost tripled and doubled so far. I haven't sold a single stock since the beginning, apart from one exception, which I will explain later. Nor do I have any intention to sell any share for the next 12 years. The reasons for this is very simple. When you trim stocks out of valuation concerns, what you are really doing is to optimize your 5-year CAGR instead of your 10-year CAGR. Which means in the short term of 5 years and below, your 50% or 100% or 200% gains even will look fantastic, especially after you sell them and you realize them. And it really looks and feels damn shook when you show the people around you that you have proven winners, that you have realized gains instead of unrealized gains that people will scoff at you. But in the long term of 10 years and beyond, because of the short-term pride and ego that you try to cover, or because of fear out of valuation compression reasons, which they will compress of course from time to time, you just have to suck it up because stock prices do not move up and to the right in one constant line. There will be ups and there will be downs. But in the long term of 10 years and beyond, your performance will be affected because you artificially cut away the stock's legs and you are not giving them room to soar as high as they should long term, especially if their fundamentals such as their business, their revenues, their earnings are still all on track and the thesis is still intact. And it's tempting to say that you can just sell now and buy back later when it crashes. But remember, nobody can time the market bottom or top consistently, not even Warren Buffett. Unless you tell me that you are Jim Simmons and you have an army of PhD mathematicians and you can clock 60% CAGR consistently over 30 years. But I highly doubt so. But otherwise, for most of us regular folks, myself included, I am no Jim Simmons, I am no professor of mathematics, nor am I a rocket scientist. We are better off finding high quality companies and letting the fundamentals compound the stock on its own over time through the zigs and the zags instead of trying to time every zig and every zag. In simple words, the key here is to let your winners run. And if you thought letting your winners run is a silly tactic, I want to share with you a viewer who recently sent me an email. He's a 50-something-year-old investor, now retired, and this is his actual portfolio from DBS that he shared with me. In it, he has held Netflix shares for 19 years, never trimming this winner. The only time he sold some shares was because he needed to buy a house, not out of valuation concerns. And he amusingly tells me, and he tells his children that they live in the house that Netflix bought. And I want to read to you this phrase that he sent me in the email that I hope will inspire all of you to think about what it means to be a long-term investor with an owner of business mindset instead of a short-term trading mindset. And he says, tell your viewers the benefits of letting your winners run. I see posts in Reddit where people are so happy selling for 10, 20, or even 200% gains. They are missing out on literally life-changing sorts of gains. So, quoting the legend himself, Charlie Munger, remember that the big money is not in the buying and selling, but in the waiting. Let that sink into your head for a moment. And that is why I haven't sold a single share of Netflix, despite it being a 3-bagger for me so far, except for one reason, which is the second contrarian move that I've made. That is, if you find another company that fundamentally performs stronger than the position you are selling, which is what I did when I made the decision to sell some Netflix to fund Exxon purchases because I did not have enough spare cash on hand, then that is a good reason to sell. Remember, the key here is fundamentals. Do not be biased by the stock price when making these sort of sell decisions just so you can buy another stock. For example, there were two reasons why I made this move. The first is that Exxon has an average revenue CAGR growth of over 30% at the moment compared to Netflix's quite a bit slower revenue CAGR of a bit above 10% per annum. So Exxon is a much faster revenue grower still in its early innings of its trajectory. And the second reason is that I made a qualitative judgment where I believe that Exxon's growth catalysts into drones, bodycam, and evidence.com is more explosive in nature long term compared to Netflix's foray into the advertising market. At that point, I remember that my Netflix position when I made this Exxon transaction, which means to sell Netflix to release cash to buy Exxon, Netflix at that point had already nearly doubled. So you really have to dissociate yourself from stock price anchoring bias and really focus on the business fundamentals from an ownership mentality instead of a trader mentality. Now, of course, there are many other reasons that I have considered. And if I start deep diving down into every granular bit, this video is going to take hours and it's going to be maybe boring for some of you. So I hope this part at least answers this viewer's question about anchoring bias and focusing on the fundamentals instead of all the erratic stock price movements of the market that will always overshoot or undershoot the fundamentals in the short term due to short-term FOMO or short-term fear. But for those of you who want a window into how I think about my positions and a deeper insight into my investing process, I recently started a small Discord Patreon community where I sort of show my investment journal and brain dump my written memos into the channel so you can see everything even more granularly. A lot of it is in written form where I share my valuation buy levels and notes on companies I am researching. So it is quite unsuitable for me to share it here in a YouTube format. The community is still very small and I still have some capacity outside of my day job to answer some of your questions inside. I've kept the cost low at $12 per month. That is the cost of 2 cai peng at some fish. But I made it purposely affordable compared to other subscriptions that usually charge thousands of dollars because my philosophy is that these subscriptions should not eat into your long-term financial returns and planning. It's not that I'm trying to spoil market. It's just that I don't run this community like many other services that keep firing buy alerts for hundreds of stocks at you every day. I run a more focused portfolio and I usually wait quite long in between my buy transactions because I am waiting for quite a big fat pitch before I even go into a position. My number one priority is still my own investing instead of selling a subscription service. So you can just treat it as though I'm just allowing you as an observer by the side, watching me do my own thing, and you can ask me questions along the way in the Discord channel. So if you're interested, I've left the link of my Patreon here in the description of this video below. I hope to see you there where you'll also meet other like-minded turtle knots in the community. Now on to my third contrarian move. On that topic of waiting for a fat pitch, I want you to pay attention to this graph of the S&P 500. The flags denoted with the letter B are my buy orders historically, and the S were my sell orders. The way to read this graph is not that I am buying or selling the S&P 500. Instead, what it is showing you is when I bought or sold my positions like Exxon, Netflix, Meta, etc. given the current state of the S&P 500 wider market in the background at that time. And what I want you to pay attention is that out of 62 transactions that I've made, 51 of them are buy transactions, far outweighing the 11 sell transactions since I started the portfolio. And that is why on this graph, you will see a lot more B's than S's. What is the moral of the story I'm trying to tell you here? It is that when you are a long-term stock investor, you should be greedy to want to own more and more pieces of strong businesses long-term instead of selling them, which means long-term, you should be a net buyer instead of a net seller, as we have seen from the earlier example of the viewer who is the retiree that held shares of Netflix for over 19 years without selling, only topping up and buying more, being a net buyer along the way than a net seller. When you understand this mentality of owning businesses for the cash flows that they ultimately generate, that ultimately belong to you as a shareholder, instead of focusing on the stock prices that are always erratic and don't represent the true underlying business, I promise you, your investing performance will improve over the long term. The fourth point I want you to notice is the earlier concept I mentioned about the Fed pitch, which is, as Charlie Munger says, the big money is in the waiting, not in the buying and the selling. So I want you to pay attention to these red lines that are on the graph. Those are spans of times of months, sometimes even 6 months, where I am doing absolutely nothing, neither buying nor selling, just accumulating cash along the way. And this, I believe, is the hardest thing in investing, which is to emotionally discipline yourself to do absolutely nothing, especially in times of FOMO and greed, where you are very keen to want to buy into ever-rising prices on bubbly conditions. Now, I know some of you will say there is an opportunity cost to waiting out of the market. You shouldn't be timing it. Now, I don't want to dive too deep into this subject. I might make this a separate YouTube episode altogether, or just dump it in my Discord investment community's memos. But there is actually a mathematical way that you can calculate how long maximum you can wait for before the opportunity cost of waiting far outweighs the very fat pitch that you are waiting for. I call this the asymmetric math of gains and losses. But of course, the caveat here is that what I'm doing applies only if you are doing individual stock picking. If you are just doing simple indexing with an ETF like the S&P 500, I highly encourage you to ignore everything that I'm telling you. Don't time the market. Just focus on simple DCA for the long term to earn the market average. That strategy alone already beats 90% of fund managers. So there really isn't anything wrong with indexing. It's just that I personally love studying businesses, and I think I have a slight edge focusing on some of the companies within my circle of competence. Now, I may have just been lucky so far, but I would love to judge my performance when I reach the 10-year mark. And it is this fat pitch of waiting patiently that has given me a 77.42% win rate by transactions when compared to the opportunity cost of investing in the S&P 500 instead. The final piece of advice I would like to give you is that buying on pessimism is one of the best ways to make money, especially if you are focusing on buying long-term, fundamentally strong and high-quality companies. Please take note that is the most important part, even before valuation. And this is a key characteristic of the way that I wait for a fat pitch, which is buying into pessimism. I usually wait for a month, 2 months, or even half a year or more, as you've seen, until certain pessimism sets in. The greater the pessimism is, the better the buying opportunities usually are, such that the asymmetric gains far outweigh any opportunity cost that I've been waiting for. Usually that has been the case, and that seems to be the case for my portfolio so far. And with Iran's parliament now effectively voting for the close of the Straits of Hormuz following Donald Trump's missile strikes, you would think that the best strategy is to run away from the market in fear, selling pieces of your valuable stocks and companies as you escape. But what you don't realize is that some of the best opportunities in the market happen following significant wars. In fact, as I create this episode on Monday evening, today on the 23rd of June, and I watch the futures market, I already know that the buying opportunity is about to present itself soon in the coming days or even tonight. I hope you enjoyed today's episode, and I hope I inspired some of you to take a more long-term view and philosophy in investing and to focus on the fundamentals instead of the short-term stock prices that usually work themselves out, especially if you found high-quality compounding companies. Thanks for watching, everyone, and I hope to see some of you passionate investors on the Patreon Discord channel.